In this video, traders, we're going to look at shorting at highs versus shorting at lows. Which is the best? Stay tuned. Hey traders, warm welcome to you. All right, so this is a common thing, right? If you have a short bias on a market, what is the best way to express that short bias? And so often we have this scenario where we're like, okay, maybe you haven't participated in the long, or maybe you have. Maybe you've gone in the long and you're kind of out of the trade now, but let's assume you haven't, and you're aligned short. Like, okay, I want to get short in this market, but I want to time it. And so what's the best thing to do? Should you short at highs or should you short at lows? What are the pros and cons of both? So what I mean by this is, okay, let's say the market's stretching out to the high side and you're basically you've got a short thesis on the market and you're taking a reversal pattern at the highs rather than a continuation pattern at lows. See, there's distinct difference is that, you know, at your highs, the market's still going up and you're looking for that turning point, you're looking for the market to come back and then potentially go lower, versus, hey, when I'm shorting at lows, I'm trading continuation pattern because it's already moved from high to low and I'm expecting it to continue lower. So there's pros and cons with both, and I think they're both different trade ideas, and for me, they sit in different buckets in my trading strategy library. And so even though technically I'm still expressing the same trade on the market, a short idea, should I say, not short interest, get confused with how much stock is held short. But the point is that sometimes you have to structure the trade a little bit differently to think a little bit differently about the trade. Okay, so imagine if we're shorting at highs here. I'm going to say that one's highs and that one's lows. So shorting at highs would be stuff like, okay, we're taking a double top type trade. Hopefully you can see that orange on the chart. I'll go over it again in the purple, guys. Hopefully you can see that better now. But shorting at highs is effectively like, all right, I am looking for some kind of reversal pattern at highs. So maybe it's going to be that double top pattern. Maybe it's going to be a little mini head and shoulders here. It's sort of in the upper half of the trade so far, if you like. So probably really, by the time we look at that, that will be the other upper half, because you only see that amount of trade, you wouldn't have seen the right hand side of the chart. And so that's like, okay, I don't know if it's turning yet, but I'm kind of taking a little bit more risk for the chance that they get a lot more juice out of the trade. Now the thing is with this is that at that point in time, you don't know what's happening, right? You think, okay, maybe it's range bound market, maybe it's pushing higher. There's no evidence that there is an overhang of supply coming in, and your objective is to look for that supply demand shift. And so these can be lucrative, but often you don't know how far it's going to go, and it starts out as a mean reversion trade. Imagine if you were taking that trade there, you probably wouldn't expect it to come down here. And so maybe you're taking for a test of lows, maybe you're taking for a test of midpoint, and it's almost it is a short trade, mean reversion trade. But where it gets interesting and where you can really leverage on things is that you can then turn it into a continuation play. More on that in a moment. So shorting the highs would be kind of selling the double top, maybe selling that little mini head and shoulders there, just about make it out. Shorting at lows would be the same type of pattern on chart. Let me just redraw it quickly in the purple. It's supposed to be the same pattern. I know it's not identical, but it's supposed to be very, very similar. Would be stuff like, okay, I'm going to sell a break of this low here. I'm going to sell this bear flag here. Maybe I'll sell this pullback here. Now the advantage of shorting into lows is you have momentum behind you, right? We tend to think that if the trend is active and it's aggressive and it's moving, and if you've got a well-timed entry, then the odds are generally more on your side than trying to catch reversals. And most people steer. The funny thing is that most people will steer clear of this. Like, it's gone too far, it's come back from highs and lows. And in actual fact, this probably has a higher probability of success. If you're shorting this bear flag after it's done all this, come down, broke through a low, flagging below a key level of support, that's probably got a good chance of going lower. But the difference is the magnitude of the move may not be as much, well, unlikely to be as much as shorting from highs. I mean, it makes sense to it, it's almost obvious, but that's worth stating, because this move here, to me, is a high probability chunk of the move. You've got to time it. Of course, there's lots of stuff that go into play, and often it can kind of snap back on you. But you know, there are certain setups that are high probability, but it's not, you can't have everything, or very, very rarely do, sometimes you do and it's nice, and that's when you should really, put the throttle down. But if you have the high probability setup, often that's not going to give you that decent risk reward, or it's not going to give you a massive kind of magnitude move, order of magnitude move like this kind of thing would, which is okay, but you've got to be nimble, you've got to be prepared for it. So shorting a lows, we setting a break of the low, setting a flag, maybe selling a pullback on here. But as you get lower, you can have the probability of success starts to diminish, because the further the market moves, the more likely it is to reverse back. Now you might say, yeah, but the further it goes in momentum, there is a sweet spot, and this is probably the sweet spot here visually, is like, okay, we've broken structure, we are repricing to the low side, and we are just exploring new price. And then as it comes to the end of that cycle, it starts to pick up speed. That's when we get the exhaustion type moves that then start to stagnate out. Maybe they do a bit of reversal, maybe they kind of go into a consolidation period, but we tend to have that. And so our job is to, if we're trying to trade this, is to wait for the break of structure, look for the acceleration momentum, and then try to come out before that momentum stops or just completely reverses. And that's the high probability chunk. And so shorting at lows can be a quick, good scalping opportunity, because there's more urgency. It's broken structure, it's going through lows. There tends to be more opportunity there for a quick trader who goes in, spots opportunity, puts on size, gets out quickly. That's probably a good trade to take. However, when you are a little bit more of a calm thinker and more structured, that might be too rushed. And so you go, okay, how can I get short on this? Maybe I need to look for the turning point. Maybe I need to look for this. Now, the downside of this is these things, not always, but I'm generalizing a bit here. Sometimes these can take longer to turn because you are one of the first to the short party, right? If you're selling at this fresh high, there's no real urgency on the downside. There's no real concern. Longs are okay. No one's really that hurt. And so you're not going to get that momentum. But that's the benefit of doing it, is that, okay, maybe this is now going to have the highest probability of success, but if it starts to go and you are right, all of a sudden you're well on board and you're positioned as that momentum starts to come in and pick up. And then you're in a beautiful position, because you can say, right, do I want to take it off at lows as I planned, or do I want to take off half and look for this type of break? And then the perfect scenario is if you're in from kind of the rotational trade, reversal trade, shorting at highs, and then you're the perfect scenario is you add to the trade, but let's forget that for the moment. Perfect scenario is you're in there and you have the ability to be able to ride it for the last high probability chunk and say, right, great, I was in from the highs, I managed to sit through the break, now we're picking up steam, now we've changed phase from a reversal type market now into a trending breakout market. I need to think differently. I need to be sharper, I need to be clearer about being able to come out here and not expect the market to continue on so much. Now, of course, it's some instances you're going to get a long move. It's going to be the start of a big trend, and maybe that trend carries on for multiple hours, multiple days, multiple weeks, multiple months, right? We don't know that. But the point is that I think these are two very different structured trades. And when you're looking at price and saying, hey, I think that's a short, I'd like to get short this market one way or the other, just understand that trading it short before it's turned is a higher risk trade, in my opinion. This is my opinion. You might disagree with me, and absolutely, put your thoughts in the comment section below, guys. I think it's a higher risk trade, or can be a higher risk trade, but the reward and potential is higher. So that's the risk and offset you take. Now, the danger you also have here, kind of finally on this one, is that if you constantly keep trying to attack the short, and get stopped out, you then have no firepower left, or your risk is right at the max daily loss limit when it starts to get going and you really want to start pressing it. And so these can be difficult to time, but if you get on it, then obviously you can build on it and you can get a decent risk reward ratio trade. So if that's something that you don't like to do, and you say, hey, you know what, I would rather wait until the cavalry has come and the horses are riding, so to speak, and jump on that horse for a little bit and jump off before it stops, rather than trying to get the horses to go. Bad analogy, but I think you get the point. And so you're waiting then, say, okay, maybe the chance of this going an extended period is low compared to this. However, it's high probability. So maybe it boils down to, what do you prefer? Do you prefer the higher risk reward ratio trade, where you can okay, probability is low, but if you get on one, you can get multiple times your risk? Or do you prefer the kind of higher probability trades, but you're perhaps not going to get many multiple times your risk? If it's structured right, maybe you can. Again, I'm generalizing with all these things, you can structure them slightly differently, but I think that's the difference between selling at highs versus selling at lows. Waiting for the move to happen and jumping on very quickly and jumping off is very different than positioning and then trying to anticipate that turn, getting on the turn and then riding that turn lower. Different skill set, maybe different personality type as well. Take care, guys. See you in the next one. Keep your risk managed. Bye-bye.